week's lecture, we're going to be looking at decision making. And the first important thing that we need to understand is when we make a decision, we only take relevant costs and benefits into account. Now that sounds very obvious, so I just want to look at a really basic example with you guys to explain what I mean by what is a relevant cost or a relevant benefit. So in this basic example over here, you're deciding whether you should drive or fly to Cape Town, and you've been provided with the following information. The cost of a return air ticket is 3,000 Rand. The cost of petrol, and it's also return, is 2,000 Rand. And the car insurance per month is 300 Rand. Which costs are relevant to your decision? So when you're deciding now if you're going to drive to Cape Town or fly to Cape Town, which costs will you take into account? What costs are relevant? Now, the reason why I use an example like this is it's not management accounting related. So if we can apply logic to an example like this, you should be able to apply exactly the same logic to a management accounting example. So the first cost that we're given is the cost of the air ticket, 3,000 Rand, and it's a return air ticket. Is that relevant to my decision? Does that help me decide whether I should drive or fly? Definitely. This cost is going to be relevant. The same thing with the petrol. The cost is also going to be relevant. When I'm making the decision and I'm not looking at qualitative factors, I'm only looking at this from a financial perspective right now, I can see that if I drive, it's going to cost me 2,000 Rand in petrol. However, if I fly, the air ticket is going to cost me 3,000 Rand. So it's 1,000 Rand more expensive if I fly. Both of those costs are definitely relevant to my decision. However, my car insurance per month of 300 Rand, please note, regardless of whether you drive to Cape Town or you fly to Cape Town, you're still going to have to pay the car insurance of 300 Rand a month. So can you see that doesn't affect my decision? So it is not relevant. Okay, so the relevant cost which will impact my decision is the air ticket, the cost of the petrol. However, the insurance, regardless of what I do, I still have to pay the 300 Rand, so it is not relevant to my decision. So you can see that applying logic to a situation like this, we can easily determine whether a cost is relevant or not relevant. Let's now look at the definition of a relevant cost or a relevant benefit. So this is my definition. Relevant costs and benefits are future cash flows that differ between the various alternatives being considered. So please note, guys, you can see there are three components over here. Firstly, it happens in the future. Second, it must be a cash flow. And third, it must differ between the various alternatives. Let's go and apply this definition to the basic example that we just looked at. The cost of the air ticket is 3,000 Rand. If I decide to fly, I'm actually going to have to pay 3,000 Rand in order to purchase the air ticket. So it's a future cash flow. Does it differ between the alternatives? Well, what are my alternatives? Either I can fly or I can drive. If I fly, I will pay the 3,000 Rand for the air ticket. If I drive, I will not. So it differs between the alternatives. So this is relevant because it complies with all three components of my definition. It is a future cash flow that differs between the alternatives. The petrol is exactly the same. If I decide to drive, I'm going to have to spend 2,000 Rand on petrol. So that is also a future cash flow. Does it differ between the alternatives? Yes, it does. If I decide to fly, I won't incur the cost. I only incur the cost if I drive. So because it differs between the alternatives, it is relevant. So you can see both of these costs comply with the definition of a relevant cost. They are future cash flows that differ between the alternatives. However, the car insurance. This is a future cash flow. I'm going to have to pay 300 Rand every month in the future in order to insure my car. However, it does not differ between the alternatives. So because it does not comply with all three components of the definition, it is not a relevant cost. Okay, so the car insurance is therefore not relevant. So still applying the definition from above, the following will not be relevant. Any money that you have spent in the past. Now, money spent in the past, guys, is referred to as a sunk cost. So any money spent in the past or any sunk costs will not be relevant because we can't do anything to change the past. And you can see it does not comply with the first component of my definition. Money spent in the past is obviously not a future cash flow. So it doesn't comply with the very first part of my definition. Second, if it is not a cash flow, it is not relevant. So for example, depreciation, which is not a cash flow, will not be relevant. So any costs that are not cash flows will not be relevant. And then lastly, if it does not differ between the alternatives, then it is also not relevant. So that's the third component that we are looking at over here. Future cash flows which do not differ between alternatives will also not be relevant. And in my example, that was the car insurance in our basic example. However, we're going to look at another example over here as well, where I talk about allocated common fixed costs. So for example, guys, let's say we're dealing with a company that has three different divisions. We've got division A, division B, and division C. And we have head office costs, which are allocated to the three different divisions. So head office maybe performs some functions for these divisions. Maybe all of the accounting is done at a head office level, all of the payroll, all of the admin might be done at a head office level. And because of that, head office incurs costs. And the head office costs are going to be allocated to these different divisions. And let's say we're going to keep it very simple over here. Let's say that the total head office costs are 300 Rand, and they just split them equally between the three different divisions. Now what we're doing is we're going to assume that the company wants to shut down division B. If they want to shut down division B, what's going to happen is the head office costs are still going to be 300 Rand. But instead of the cost being shared equally between three divisions, division B has now been shut down, so the cost is going to be shared between the remaining two divisions. So we are going to allocate then 150 Rand to division A and 150 Rand to division C. But you can see if we are trying to make a decision as to whether we should shut down division B or not, the total cost from the company's perspective does not change. The total cost is still 300 Rand. So what's very important is the cost does not differ between the alternatives. If we do not shut down division B, if we continue with division B, the company head office costs are 300 Rand. However, if we shut down division B, the company costs are still 300 Rand. So the cost does not differ between the alternatives. It's not relevant. If you look at what I've said in the paragraph above, allocated common fixed costs are incurred to support the organization as a whole, and they will not be relevant because they do not change whichever alternative is chosen. Decisions merely lead to a redistribution of the same cost, and it does not affect the level of cost for the company as a whole. So we saw for the company as a whole, the cost is still 300 Rand. The only thing that changes is we are redistributing the same cost. So instead of splitting the cost equally across three departments or three divisions, we are now splitting the cost between two divisions. But in total, the cost does not change. So it's very common in questions, in decision-making questions, that you will come across allocated costs. And please note, guys, wherever you see an allocated cost in a question, it is never relevant because it does not differ between the alternatives. All right, let's just quickly clean this up over here. All right, so you don't actually have to learn all of this over here. You just need to learn the definition, because if it doesn't comply with the definition, then it won't be relevant. Because I've just shown you that all of these points below are because they don't comply with the definition. This doesn't comply with the first part of the definition, the second part of the definition, and the third part of the definition. Now, guys, instead of applying the definition, another way that we can look at this, which is sometimes a little bit easier, if we can avoid the cost or the benefit, then it is relevant. And if it cannot be avoided, then it is not relevant. So once again, I want to go back to my basic example over here. The cost of the air ticket, the 3,000 Rand cost of the air ticket, this cost is avoidable. I can avoid the cost by rather driving. If I drive, I don't incur the cost. And what did we say in our notes? If it is avoidable, it is relevant. Because it's avoidable, it is relevant. Exactly the same thing, guys, for the petrol cost. I can avoid the cost of the petrol because instead of driving, I can fly. And if I fly, I won't incur the petrol cost. So because it's avoidable, it is relevant. However, the insurance of 300 Rand a month is not avoidable. Regardless of what I do, whether I drive or I fly, I still have to pay the 300 Rand a month for the insurance. So because it is not avoidable, again, look at your lecture notes. If we cannot avoid it, it is not relevant. So therefore, this is not relevant. So you can see you will come to the correct conclusion. Either you can apply the definition, or you can look at the general rule and determine whether it's avoidable or not. And either way, if I apply the definition or if I look at this general rule over here, you will come to the correct conclusion. And that is how we determine if something is relevant or not. And when we are making decisions, we only take relevant costs or benefits into account. We then need to discuss opportunity cost in a little bit more detail. So first, what is an opportunity cost? It is the potential benefit that is given up when one alternative is selected over another. So guys, whenever the company has to sacrifice something, if by making one decision they are sacrificing something else, we then have an opportunity cost. So if we go back to this basic example, let me add to this example and say, when you go to Cape Town, you don't have any annual leave left. So you're going to have to take unpaid leave. And let's say normally you earn 2,000 Rand a week. Those are your wages. This is a perfect example of an opportunity cost, because if you do go to Cape Town, because you don't have any paid leave left, you're going to have to take unpaid leave, which means if you go to Cape Town for a week, you are going to lose out on earning wages of 2,000 Rand, and that is an opportunity cost. So when we're working out the cost to go to Cape Town, we need to add 2,000 Rand, which is an opportunity cost, because of the fact that you will not be earning any wages during the period that you are away. So that is a good example of an opportunity cost. It is the benefit that is given up when one alternative is selected over another. Okay, if we go to Cape Town, you won't earn those wages. Now, what's very important, guys, is opportunity costs are only relevant when we are using the incremental approach. We're going to come back to this a little bit later in the lecture. There are two different approaches that we can use for decision-making questions. Either we can use the total or the comprehensive approach, or we can use the incremental approach. So we're going to cover this in detail now, but please note, opportunity costs are only relevant when we are working with the incremental approach. We do not take opportunity costs into account when we are working with the total or the comprehensive approach. So you need to note when you're doing your calculations, what approach are you working with? If we are using the total approach, we don't take opportunity cost into account. But if we are using the incremental approach, we do take opportunity cost into account. And when we actually look at a couple of examples throughout the lecture, you'll see why that makes sense a little bit later. But for now, please just remember that. How do we calculate an opportunity cost? The rand value of an opportunity cost? It is always my lost contribution. So it is the contribution that I am losing out on or sacrificing by selecting one alternative over another alternative. What is contribution? Please remember, contribution is just my sales less my variable costs. And that is always how we work out the rand value of an opportunity cost. And if we are doing our calculation using the incremental approach, we will take the rand value of the opportunity cost into account because it is relevant when we are using the incremental approach. Then we need to look at how you determine what the relevant cost of materials are, the relevant cost of labor, and the relevant cost of machines. And for the purposes of this discussion over here, guys, I want you to assume that we received a special order from a customer. And the customer wants 1,000 units of the product that we make. So first, when we are trying to determine what the relevant cost of the materials is, let's say we need 1,000 kilograms of material for this specific order. These are the questions that you need to ask yourself when you're trying to determine what the relevant cost is. First, if the material is not in stock, so we don't have any material in stock, obviously we're going to have to go and buy the material so that we can make the units for the special order. So if it's not in stock, the relevant cost is going to be your current purchase price, whatever you pay in order to buy the 1,000 kilograms of material. That's the easiest situation that you'll be faced with, and that should make sense to you. The relevant cost, if you don't have the material on hand, the relevant cost is the cost to go and buy the material. However, it gets a little bit more tricky if you do have the material in stock. Let's say, once again, we need 1,000 kilograms of material for this order from our customer. However, all 1,000 kilograms are sitting in stock, and we purchased the material for 5 Rand a kilogram. Now be careful, the relevant cost cannot be the 5 Rand per kilogram because that is a sunk cost. That is money that you spent in the past. If this material is already sitting in stock and we paid 5 Rand a kilogram for the material in the past, that is a sunk cost and it cannot be relevant. Because remember, relevant costs are future cash flows. So then we need to ask ourselves a few other questions. Is this material something that the company uses regularly in their production processes? Because if it's something that's used regularly, if we use the material now for this specific order, we're going to have to replace it in the future because it is something that we use regularly in production. And then this is very simple. We also use our current purchase price. So exactly the same thing as we would do if the material was not in stock. So if it's not in stock, the relevant cost is the cost to buy it, which is your current purchase price. If it is in stock, but it's something that we use regularly, if we use it for this specific order, we're going to have to replace it for future production. So the relevant cost is also the current purchase price. So nothing's changed yet. However, if this material is something that is not used regularly in the production process, that means if we use the material now for this order, we won't necessarily have to replace it in the future because it is not something that the company uses regularly in their production process. So then you need to ask yourself what happens. Either the material can be sold or it has an alternative use, or it must be disposed of, or it has no alternative use. And depending on what you answer, that will determine what my relevant cost is. So let's look at the first one. Let's say I tell you that the 1,000 kilograms are sitting in stock, and we purchased them in the past for 5 Rand a kilogram. So we can't use the 5 Rand a kilogram because that's a sunk cost. I tell you that it's not used regularly in the production process, but I tell you it can be sold for 3 Rand a kilogram. Guys, you now have an opportunity cost. Why do I have an opportunity cost? If I use this raw material inventory for this order, I will not be able to sell it for 3 Rand a kilogram because I'm obviously using it for this order. However, if I don't use it for this order, I'll be able to sell it for 3 Rand a kilogram. So you've got an opportunity cost over here. You are losing out on 3 Rand per kilogram if you use the raw material for this order. So please look, if it is material that is not used regularly by the company, but it can be sold or we can use it for something else, you have an opportunity cost. Because if we use it for this specific order over here, you will not be able to sell it and you will not be able to use it for something else because it's going to be used for this order. So we have an opportunity cost. And the opportunity cost is always our lost contribution. We are going to look at an example of this a little bit later in the lecture. So for now, I just want you to be comfortable with the theory behind everything. We will get to a number crunch example where I'm going to apply this to an actual scenario. Now we're going to change this up a little bit. We still have the 1,000 kilograms in stock, so it's already in stock and it was purchased at 5 Rand a kilogram. That's not relevant, it's a sunk cost. I also tell you that it is not used regularly by the company. So that's always the first question you ask yourself, because if it's used regularly, the relevant cost is just your current purchase price. So I tell you it's not used regularly. But I tell you the company has no use for this. And they're going to pay a company to dispose of this material they're going to pay them 500 Rand in order to dispose of the material because they've got no use for this material. It's taking up space in the factory. They want to get rid of it. They have to pay a company to come and take it away, and it's going to cost them 500 Rand. Now, guys, you're not sitting with the cost. Now you're sitting with a saving, because if you don't use this material for the order, you are going to have to pay someone 500 Rand in order to take the material off your premises. However, if you do use the material for this order, you will not have to pay someone to take it away because you'll now be using it. So you have an opportunity saving. So the relevant cost, if the material must otherwise be disposed of, is a saving. It's not a cost, you're actually sitting with a saving. The last scenario that could happen is they tell you you've got the 1,000 kilograms sitting in stock. It was purchased at 5 Rand a kilogram. It is not used regularly. And they tell you the company has no other use for this raw material. They don't tell you that it's going to be disposed of. They don't tell you anything else. They just say there's no use. That means then, guys, the relevant cost is null. All right, so that is how you determine what the relevant cost of your material is. How do we determine the relevant cost of labor? First, guys, if the cost is the same, irrespective of the alternative that's chosen, remember, if a cost doesn't differ between alternatives, it's not relevant. So if it's the same for all alternatives, like my car insurance in the basic example, then it is not relevant. So for example, we are still looking at this special order here that we received from one of our customers for 1,000 units. If these units are going to be made by employees who are already working in the business and they earn a fixed salary, then the cost is not relevant. So let's say we pay our laborers, they are existing employees already working in the business and they earn a fixed salary of 10,000 Rand per month. You can see, regardless of whether we accept the order from this customer or not, we still have to pay our employees the 10,000 Rand a month. So the cost is the same regardless of whether I accept the order or not, or it doesn't differ between the alternatives, which means it is not relevant. However, if I have to hire extra workers as a result of this order, so maybe the employees that are already working in my business, they might be operating at full capacity. So if I accept the order from this customer, I need to hire additional laborers, or I need to hire casual workers, or my employees need to work overtime. Then the cost will be relevant, because then the labor cost is being incurred as a direct result of the alternative. So for example, if we have casual laborers, if we hire new employees, or if people have to work overtime as a direct result of the order, then it does differ between the alternatives. Because if we don't accept the order, we won't have to hire casual laborers, hire new employees, or work overtime. We are only doing this as a direct result of the order. It differs between the alternatives, and therefore it is going to be relevant. Then lastly, guys, if labor is in short supply and the laborers can be put to an alternative use, then the cost is relevant because we have an opportunity cost. So what do I mean? If we use these employees that are already working in my business in order to make the units over here for the special order, then they won't be able to work on the normal units that they would normally be making, which means I've got an opportunity cost. They're going to be working on this order. They can't be working on anything else. So if I'm losing out on anything as a result of this order, because my employees can't be working on something else, I then have an opportunity cost. And please remember, opportunity costs are always relevant. We said above, when we are using the incremental approach. And lastly, how do we determine the relevant cost of a machine? So again, assume that we received this special order over here from our customer and they want 1,000 units. Assume that we are going to make those units using a machine that the company already has in their factory. So a machine that they purchased in the past. Now, obviously, guys, we know money spent in the past is a sunk cost and it is not relevant to our decision. So the cost of a machine that was purchased in the past is a sunk cost and will not be relevant. Any depreciation on the machine is not relevant because it is not a cash flow. However, if we have a change in the market value of the machine, that is going to be relevant. So what do I mean by that? Let's say that the machine is reaching the end of its useful life and the company knows they can sell it today for 10,000 Rand. However, they don't want to sell it today because they need to use this machine for the special order. So they want to keep the machine and use it for the special order. However, if they only sell it after the special order, then they'll only be able to sell it for 8,000 Rand. You guys can see that the change in the market value of the machine, the decrease of 2,000 Rand, is a direct result of this order. The company would like to sell the machine, and if they sell it today, they can sell it for 10,000 Rand. However, they need the machine for this order. If they use it for this order, they can only sell it for 8,000 Rand after the order. So because of this order, the market value of the machine has dropped by 2,000 Rand. So the relevant cost that will be applicable to this order is the 2,000 Rand, the decrease in the market value of the machine.